Cool. Hi Werner, and thanks for joining this interview with us today to discuss the Sanlam Global Growth Fund. To kick things off, I guess, could you give us a brief introduction just on yourself, I suppose, and your tenure in the markets?
Hi Conrad, thanks for the opportunity. I've been around almost 40 years now in the financial markets, qualified as a chartered accountant, but has basically worked as in the investment markets my whole life, and the last 20 years of that here in Australia.
And I guess with the Global Growth Fund now, I suppose just to sort of get a deep dive into the philosophy behind, how the fund operates and what it tries to achieve for clients. Can you give us a brief introduction to sort of just the core investment strategy of the Global Growth Fund?
What we have tried to do with the Growth Fund is to just give exposure to a number of core components that we use normally for our clients. So we have got one of our core investments would be our Global High Quality Fund. Really investing in the investment universe would be the top 100 companies, really good companies in the world. Maybe the universe would go further than 500, but they invest really in the top 30 companies that they found offer the best value out of the fund, with at least a 10-year track record. So immediately, just on one of your core components, you get exposure to some of the best companies in the world. That fund is based on free cash flow forward. So it's a conservative thing, but what you find out that high quality companies actually gave your best growth over a long period in the markets, just because of the quality of the management and quality of the cash flows that are generated out of these businesses. In addition, to the same extent, the Sanlam Real Assets Fund, again, is managed by our managers in London. He's been around for many, many years, running similar assets for high net worth individuals, private clients of some of the major investment banks out of London. And the strategy, currently still has about £1 billion under management. Similar thing, it's a split between property, specialized property as they call it, in other words, infrastructure type hospitals, schools, student housing around the world, real infrastructure, waterworks and other things that happens around the world, and other properties that they invest in. So just by investing in the fund, you actually get exposure to, again, between 20 and 40 counters from around the world, based on cash flow, and you obviously, out of that universe, you try and pick the best value at the moment. So what we've tried to do with Sanlam Growth Fund is just have a fund that we can allocate to the best potential or the best opportunities of these really good fund managers around the world at any stage.
And I guess with the type of setup of the fund being almost a fund of funds, I suppose. Maybe it's not exactly that. Are there any differences in terms of the considerations that you would make when it comes to portfolio management and just how you're allocating that investors should know about when it comes to allocating into fund managers versus individual stocks and managing that as a separate portfolio?
Yeah, there's nothing stopping us from going for individual stocks. We certainly, if the right opportunities are there, would consider individual. The advantage for us is diversification, which in any way, shape or form reduces your risk substantially. And the absolute growth of opportunities that has come with the growth in ETFs and fund managers listing their instruments on the stock exchanges as well through ETFs. We're very keen investors, and it will certainly feature in the portfolio as we go on, of PM Global Fund and of WCM, International High Quality Fund. Again, it is alternatives to some of our cores, but you would at certain stages say, listen, West Coast may have a lot more of tech and real high growth companies, while our normal Sanlam Global High Quality, which is really based on cash flow and future earnings, may be more conservative, so you may move between the different funds as we go forward. Again, there's no stopping us of picking individual companies at any stage and investing directly in it. What we will not do is having any individual share more than 4 or 5% of the portfolio.
Very well diversified.
Yeah, it will always stay very well diversified, as part of our risk management. And a little bit, that's the way that I think the fund is managed, is try and make sure that the asset allocation is right. Again, it's we keen investors in, if we increase our Australian exposure into small company funds. One of our most likely investments, or good investments over time, was a Hyperion Australian Growth Fund. It's a lot better for us in terms of getting exposure at the right time to that sector, to go through the fund and try and pick individual shares. So again, this is most likely not necessarily the total portfolio of a client, but a core investment or a core chunk of his investment. And we do believe, there's opportunities to go for individual opportunities, and there are times when it may suit the portfolio to increase your direct exposure to individual equities and other things as it goes on.
Yeah, I guess I can totally see also the benefit of getting exposure to international markets via fund managers that are on the ground in those areas, rather than trying to be awake at all sorts of times of the hours and identifying stocks in the US and India and things individually. Into the sort of, I guess, outlook that you have as well, and sort of how you're making the investment decisions. So when it comes to the asset allocation of what markets to invest in, what asset classes to invest in, whether or not it's via a fund manager or just directly, what are the main considerations that you're making from an economic standpoint, or sort of more of a overarching standpoint to make those decisions?
Yeah, I think like all fund managers, you follow global economic growth and prospects very closely. Economic policy in different countries has got a major influence on our thinking. It's a lot better to invest in a good market with good policy than to try and get the kind of growth that you can get out of a market like that out of a poorly run macroeconomic policy country. A good example is India. India, we've got a core investment in our India Avenue fund, and predominantly driven by a massive improvement in the last 5-7 years under the current in economic policy, transparency, stability of currency. So that's a kind of opportunity. If you pick the right market at the right time with really good macroeconomic policy, you do really well. The other example is the United States over the last 10 years have just outperformed the rest of the world very substantially, the US indices, primarily driven by the absolute growth in technology. Now, lately supported by AI. So, if you have a really good macroeconomic policy, and the United States, whatever the short-term distractions may be under the new president, it's still the ultimate capital market, free capital market, where capital gets allocated freely to the best opportunities. And that's the kind of market that we believe create the best opportunity for good capital allocation and good managers to make the money. So, like everyone else, interest rates weekly worldwide in a stage where interest rates are coming down, which has always been positive for growth and equities. With all the other distractions with tariffs and everything else, and global concern about governments overspending and running macro deficits at that stage. A lot of the growth that should have come from a reduction in interest rates to property infrastructure assets as new, really. And we see actually attractive valuations in some of these sectors, but we would still be careful as all this uncertainty makes the move to lower interest rates, and the benefits coming out, the confidence that should come out of lower interest rates in these sectors are still seems to be lagging. So, to come back to your question, it is really the combination of macroeconomic conditions, macroeconomic policy, and then finding the right opportunities and asset allocation within those that changing environment.
I guess a lot of the Australian investors that we manage are sort of looking at global markets now. Even sort of over the last couple of years, they've started to sort of see the opportunities in the US markets that some of the trading platforms here in Australia now give access to. How does global markets compare to the Aussie market? Obviously, the fund, the way that it's structured, is highly diversified, and so you'd expect some level of reduced volatility in the type of returns, which is not so different to what you experience in Australia, I suppose, compared to a lot of the global markets. What benefits can investors practically see by investing in global markets sort of way, compared to just being 100% in Australia, from your point of view?
Yeah, I think fortunately for us and for investors, the world has really opened up for investors to find opportunities globally. It is a lot easier with technology nowadays to do these things. I remember in the old days, when it took you 2 weeks just to try and settle a trade internationally, or to try and find a broker it was almost impossible to find a broker to open an account for you. So I think this growth in the platforms is a really good opportunity for people to learn and to get access to international markets. Should one get access to international markets? Absolutely. There's a quote nowadays that keeps on going around, that the United States, as I just said, which is really one of your best markets, or had been one of your best markets to invest over the last 10 years, now constitutes only around 5% of the world population, about 25% of the world GDP. But the US market is now 70% of the market cap. So money has followed the best opportunities. I think it's just natural for investors, and we've seen it first with the Future Fund in Australia, which has certainly for the last 5-7 years been more invested over internationally than locally. And now with all our big super funds, which are saying the Australian market is just not big enough for them to invest. It is still a lot better, in my opinion, and easier for smaller investors to get the benefit of diversification when you go internationally. Unless you feel comfortable and you can pick shares. But there's definite benefit in going via funds or ETFs if you go internationally early on. Again, I think the super fund industry in Australia is now more than 50% invested internationally, and it will continue to grow as the funds under management grows, and the opportunities will just be much more and better as a whole to the local one. It's not, again, what we found in the Growth Fund, every now and then, like it has been now lately, you look at Australia and say, hey, this market is a lot cheaper than the rest of the world. And we also in the phase of interest rates coming down. We're also in a phase of, in our opinion, not so good macroeconomic policy with government overspending and holding back the economy via bad policy. But overall, it has been a very good time to get exposure to and growth companies. One of our investments that we really do like is the Hyperion Australian Growth Companies Fund, which, after the a lean period, had a very good bounce back in this year. And I do think for Australian investors, the Australian market has got enough opportunities. So the other point that is absolutely just essential as well, and which is well known as well in Australia, is if you look at where the massive growth have come from in the last 10 years, from tech, it is not Australia's biggest strength on ASX. We have got a dearth of good quality tech companies, and it's a lot easier and better to probably get exposure to the international tech companies, of which there are so many around the world. So it's the same, for example, in property. I think in the United States and Canada, there's something like 37 different sectors of REITs, of real estate investment trusts, from, like I said, student housing to forestry to towers, for the distribution of tech to all their clients. So you can get a much better exposure to different sectors where the real growth may be by finding these opportunities internationally. Compared to where in Australia you have 3 data center companies which cover that. And some of them may be high, not as attractive as investments because of cash flow reasons and other things.
Yeah, so capital flow, institutional flow, and if you're following that, obviously there's more opportunity or just more potential growth, and then on top of that, it's just a broader scope of choices to have access to. Leading on that, what is because right now the US is, as you mentioned, sort of taking strong strides via the AI phenomena, and it's really interesting to see some of these companies also just have crazy valuations with almost blue sky type opportunity sort of perspective when it comes to analyzing those valuations. What's your opinion on sort of the current state of tech in the US, and how is the Global Growth Fund potentially, I guess, either navigating that or potentially staying away from it? What's the exposure that you guys are looking at there?
Yeah, we if you look through our investments, you will find that the core of our investments have probably not got enough exposure to that. We are ourselves, I mean, some of the AI valuations is just crazy, but we absolutely do believe that AI will make has a massive influence on markets and on businesses as it goes forward. Where I think ultimately it will lead to massive improvements in productivity, better systems, better execution globally. It's just based on better information. AI means better information available to everyone, which inevitably will lead to improved decision making, improved allocation of capital, improved business results. So while we do believe in it, we have got very limited direct exposure to it. Again, via property, REIT Property Fund, via the Infrastructure Fund, which invest into these data centers around the world, via the Global High Quality Fund, which normally would have exposure to your Microsofts or one or two of these major companies. SAP had been a major investment. SAP in Europe had been a major investment for a long time for the company. So they would certainly have exposure to many of the companies in that area. If you look at Microsoft, which years ago was regarded as also high-tech companies at crazy valuations, if you look at them now, the cash flow that's generated by Microsoft, dividends paid, and the buybacks makes it a real good quality company that generates incredible cash flow.
Warren said, yeah. And
with a incredibly good record of allocating that capital as well. So in the global high quality, you would almost inevitably have some exposure to the top companies, being the top companies in the world. And like I said, if you follow it through to property or to infrastructure, you will get the exposure. Probably less than in your major trend following funds, as it will only be part of investment in that fund or sector that we follow.
Yeah, I mean, it's really interesting, but I think you're right. It's a really, you can exposure to the thematic of AI via sort of different avenues rather than just NVIDIA, which has these risks with potential valuation. But as you mentioned, could be a Microsoft situation where the free cash flows and all the metrics kind of translate to warranted. Okay, and then a couple final questions. When it comes to, I guess, to take on a bit more of the devil's advocate point of assessing this as an investment opportunity, what are the risks that investors should be aware of when investing in a fund like this, or just even globally? Would you say that's just important to consider?
Yeah, I think in any investments, all the risks are, and if you read the PDS of the document or TDM, TMD, you will see all the risks are the same, and it's spelled out there. Obviously, the major one, a lot of the risks are mitigated in this case through diversification, being in different sectors, different places around the world. One of your major risks gets mitigated. To the same extent, we've seen global markets lately moved very differently from the past, in that markets as a whole go up and as a whole goes down a lot more than in the past. So, I mean, you will always have market risk, which in a fund which is as diversified as this is probably a major risk. What we have found is that this is actually a very good investment if you read exactly what the documentation says. It's taking a view of at least 2 years or going forward, getting diversified exposure to the best or the most appropriate asset classes at that stage growth. But what we have found as well is the moment you diversify, clients still expect maybe NVIDIA-like growth. Mm-hmm. But so I think it's important that clients understand what we are doing here is diversifying your exposure to many different sectors. Don't be disappointed if you don't have NVIDIA type risk, NVIDIA type growth. But that's the difference between betting on one share and it might go wrong, and investing in a fund like this. The risks is it's a lot less than doing individual investment in individual shares, just by the different asset classes as it go. The risks massively is skewed towards market risk, in that the world as a whole may be negative. Now, obviously, we look at these investments as well, and we try and expect where it may go wrong more than that. There's nothing stopping the fund to move into cash and just earn our 5% or 3% or on cash as and when we require. And that is probably our biggest risk mitigator, is if we feel incredibly negative. In each of the funds and the managers as well, when we speak to them, etc., we get their feeling from them and their market view from them. If we talk to the fund managers, these people are normally very open about they are very concerned and they're building up cash, or no, it's absolutely time to invest, and they're very positive about it. In terms, I don't think there's much other investment risk. The fund is set up, and there's a proper trustee and proper documentation, administration behind it. It is really just the market risk, which I think is a major risk.
I guess to sort of wrap things up, it'd be good to give investors a couple of details in regards to sort of how they can practically take advantage of this fund. Obviously, it's a retail fund, and so everyone will have access to this, not just a wholesale restricted fund. If you can maybe walk us through sort of the quality of the service providers, and possibly the returns. Just to give investors a sort of final summary of this fund.
Thanks, Conrad. The fund is an Australian unit trust, or a collective investment scheme. It's issued by Melbourne Securities Corporation Limited, the trustee as we call it. Administered by one of the leading administration companies in Australia. And Sanlam Investments acts as the asset manager of the fund. The fees is about 1.35% see-through in the whole in the manager. The performance of the fund, it's only really been going for 2.5 years or so or something. I think we're up 26% since the beginning. Probably a little bit sideways the last 6 months, 9 months, as we try and navigate global markets. And like I said, we expect the benefits of some of these interest rate cuts to start coming through in many of our sectors as we go forward. Look, long term, it's in our opinion, a really good building block in a further diversified portfolio. It's, in our opinion, even though by being invested in mostly assets, which is equities around the world, and the determination will always be a growth, because we can be up to 100% in equities. It is probably through the diversifications and the difference in the sectors that we are exposed, probably a much more conservative exposure and a little bit less volatile exposure that you would get from other investments. So we really like the fund as a core building block in our portfolio growth and understanding where we go. It's not a fund that you have to watch every day and say, where has it moved to, or what's the story. It's the kind of investment that you hope will do over time exposure to growth, and through the right asset allocation, end up with just a above average growth, above market growth, by doing the right asset allocation as you go forward. It is we found a very good entry for many people as well. A little bit less to worry about than taking risk on specific only one share, or much higher risk opportunities.
Okay. Cool. Well, thank you very much for your time, Werner. I appreciate it, and I'm sure our investors will find a lot of insight and value into this conversation. Thank you.
No, thank you very much, guys.